If you are enjoying the FTSE show, I would massively appreciate you smashing that like button for me to help other people see these episodes. It is the best way you can support what I'm doing and the show. I would massively appreciate it. Roughly speaking, we get between 15 and 20 likes. So if we can beat 20 likes, that would be amazing. Thank you so much for your support. Today we're going to take a look at Motorpoint, a used car company, FTSE Small Cap stock, I believe. Let's take a look. Hey there guys, how's it going? My name is Chris Chillingworth. Welcome to the FTSE show. Today we are going to take a look at Motorpoint plc, epic code MOTR. They are a used car company to rival the likes of Auto Trader. I think it's going to be pretty hard pressed. Auto Trader are a very solid company. We may look at them in a future episode as well because I think they would score pretty highly on our leaderboard. But let's dive into the numbers and see how Motorpoint get on. Okay, so taking a look at Motorpoint, the car supermarket company. I don't really know much about this business, but the epic code is MOTR. They're in the FTSE Small Cap Index, and they're under the sector of retailers. So Motorpoint plc, not long been on the exchange. As a result of that, we've only got 4 years worth of data. We do have March 2019's data, so we're pretty up to date with that information. Straight away, we can see obvious revenue growth here. We've gone from 729 million to 82 million, 991 million, and then they've hit the 1 billion mark in 2019 with that 1 billion and 58 million, essentially. That is some strong revenue growth there year on year, which is great. That's exactly what we want to see. We look at cost of sales. Cost of sales has also grown in accordance with that. And if we look at that gross margin percentage rate, pretty much at the same rate of the revenue. So whilst the growth in revenue is a really positive kind of tick of the box, the actual cost of doing business, the cost of sales, has grown in pretty much exactly the same rate. As a result of that, their gross profit has been going up, but not by a huge amount. They've gone from 55.7 million to 62.2 million, then 76.4, 79.9. But that's all positive. It's all going in the right direction. There is definite growth in their profits, and that's all a good sign. The margin is very slim, so I mean that's a concern for me, because if we're already starting at that level, once you've then gone through expenses and costs of running the business, they're not necessarily going to be left with much by the end, unfortunately. So that is a concern for me already. We're obviously going to go and have a look at that in a moment, but that's going to suggest to me that this may not be a company at the top of the leaderboard for sure. But that doesn't mean they're necessarily a terrible business. But as we can see here, you've got a company bringing in over $1 billion in revenue, but it's costing you nearly $1 billion to just to do that. Then, and you're only left with £79 million. It's a pretty small margin, and all that's going to take is a big jump in expenses or taxes or depreciation costs that might come in 1 year. And, we could end up seeing Motorpoint posting a losing year. Now, if you're an investor who's looking for a growth stock that's going to keep going up and up and up, generally companies with these tight margins don't do that well in that respect. But that's not always the case. It's just a pattern that I have noticed over the years. We can look at expenses. Expenses are relatively high, but okay. This is kind of what we would expect. If you're bringing in $1 billion and it's costing you 55 million to run the business, that's pretty good. You can't really argue with that. But obviously that's eaten into the 79.9 million that was their gross profit, right? So we've already deducted 55.3 million from that before we can start looking at profits. So you can see here, that's a big chunk of that's gone now. We can tell that from the operating profit below here. So this is the profit. This is essentially the gross profit minus the expenses, the R&D and the depreciation, which aren't entered into their accounts. So we can assume that those R&D expenses and the depreciation costs are factored into the expenses, which is some companies often do with their accounts. But we've got an operating profit of 17.3 million, then 12.9, 23, 21.3, and then 24.6 in the last year. So again, we've got growth and operating profit, but now we're starting to play with much smaller amounts of money here. We've still got some more expenses and costs to come out. The interest on debt is fine. 1.7 million last year represents 6.9% of the operating profit. It's nothing, no concern at all there. The interest being paid on debt is not astronomically high or of any concern. There are no extraneous costs or income to worry about, which makes things a lot easier. And then we've got taxes, which obviously they don't have a lot of impact on controlling. It's just you pay your taxes essentially, but we deduct those, and these are the net earnings essentially. So in 2016, 13.4 million, then 8.7, then 16, and 18.3 is what this business was left with. That is a net earning percentage rate of under 2% a year, between 1 and 2% a year. Unfortunately for me, straight away, that's too slim for me, far too slim at a margin, and they're not going to score as well as they could have done on the leaderboard, but certainly not a company that I would be investing in personally, because there's just not enough of a margin. Like I say, all it would take is a big research and development expense or a depreciation cost to come through, or it could be some big expense comes through in the business and it could wipe out the profits. And all you need is a £20 million bill come through of some sort, or an increase of some sort, and they're posting minus figures. And if they're posting minus figures, that share price is going to take a real hit. And if I'm looking for a growth stock, I don't really want to be investing in companies where that opportunity exists. We'll go down to their assets though, and we'll go through this process as well. Assets have been growing, so that's a good sign. They are covering the liabilities, but at a ratio of 1.2, so they pretty much match assets for liabilities with a slight edge on it, which is fine. The most important thing I tend to look at here is the outstanding debts, of which on the short term, i.e. debts that have to be paid within the next year, there are none, so that's great. And then long-term debts, there are none. So this company so far have achieved what they've achieved with zero borrowing whatsoever, so that's absolutely great. No interest on debt really to worry about there, no debts to pay back, which is good because they're not making a huge amount of profit, so that would really hamper them. Looking at the reserves of the company, they've got 25.5 million in 2016. That's today now at 28.8 million. So we've not seen any growth really in the reserves. There is obviously growth by about 3 million over 4 years, but it's not enough to be excited about. And so unfortunately that's quite a flat reserve rate, which goes against them but doesn't really cost them points, just means they don't really make many points. And then we can look at the return on shareholder equity score is pretty good. So what that basically means is that the return that they're getting off the assets they have is actually pretty solid in terms of the assets that they hold. Let me just see, total current assets 143, let's call it 144 million. So all the assets of the company, everything they own, the inventory that they currently have in stock, the cash that they have in the bank, the money owed to them by other people, other companies, other businesses. You add all that together, you got their property, their plant and equipment, their deferred tax assets, all of that added together. Sorry, I should be looking up here for it's the non-current assets. So the total assets, sits at 152 million. So of all the stuff that the company owns, all of the assets added together, 152 million. And with those assets, they're using those assets, i.e. the property that they own, the inventory that they have, that all of those assets are producing 18.3 million in profits. That gives you your shareholder equity score of 63.1%, which is healthy. It's pretty damn good. So yeah, that's all not bad. What we've got here is a company I wouldn't invest in because they are too tight in terms of their margin, but everything seems to be moving in the right direction. And if they could somehow increase revenue and reduce cost of sales so that they can increase that margin, then I'd be very excited about Motorpoint. Unfortunately, the margin is far too slim. It's unlikely that margin is ever going to change in the short term unless there's a dramatic change in the way Motorpoint do business and can somehow either dramatically increase revenue without increasing cost of sales or somehow reducing cost of sales. And if they can't do that, then this is going to be the story of their growth for many years to come. They may well eventually get to the point where they've got a 10%, 20% margin, but I think that could be a long time away. And so for that reason, unfortunately, Motorpoint are not a company I would personally be looking at investing in. For these reasons, I'm not expecting super strong share price growth with numbers like this. And I wouldn't want to take the risk that would come with that anyway. And there are other companies out there that I can invest my money in that give me a much stronger chance or probability of achieving the share price growth that I'm looking for. Motorpoint are not the best company out there for me to try and achieve that with. Okay, so looking at the chart for Motorpoint Group, there has been some growth in the share price, but not a great deal. We're looking at June 2016, back when they first got themselves onto the exchange. We were looking at a price of about £2.30, £2.40. We're now looking at £3.10, and that's only really been a recent development in the last couple of months prior to doing this video. Prior to that, they've rarely ever exceeded that entry price that they came in at. There's been a lot of drops along the way, and it's not the strong growth stock that we're ideally looking for. So once again, I would say the numbers that we've just looked at certainly reflect the chart. An average company making a tiny margin but profitable, and as a result of that, there is some demand for this stock, which is pushing the share price up, but it is no way in the same league as the companies that I'm looking to invest in. Okay, so not great numbers, not bad numbers either. It's going to be interesting to see where they come up on this leaderboard. The big problem, I think, is margin. They're just not making enough margin. They've got some big revenues coming in, hitting that billion revenue, but there's just not enough play there. The net earnings are too small a percentage, and all it's going to take is a little bump in the road, and we could see Motorpoint posting some losing numbers, which doesn't go well with share price growth, unfortunately. For that reason, they're going to score not as well, I think, as some of the top companies, but let's see where they end up. I've got their little thing here. So I've already written the number down, so we can dive straight into this. This is efficient, right? MOTR then, with the numbers that we've just looked at, score 51 points. So it does put them in third place. What this means is, you could go worse in terms of stock picks than MOTR, but not my pick, not a company I would be getting personally involved in. Just not quite good enough. There are other companies out there, different FTSE companies out there that you can invest in that could produce much better results than MOTR could. But let's chuck them up on the leaderboard. So third place, we are proper building this leaderboard now. We're up to 10 companies, and of which I would say 2 are worth your time. The other 8 are no good. And this is going to be the pattern of this show. Most of the companies out there, I'm not touching. I'm not interested in them at all. There are only a very select few companies that are making the grade. If you want to bypass this entire series and know exactly what those companies are, there's a link in the description down below where you can get involved in the work that I'm doing. Otherwise, thank you so much for tuning in. I hope you're enjoying this analysis series. If you are, please give us a like on the video. That would be huge. Like I say, if we can smash 20 likes for this particular episode and beat that, then I'll be well happy. And it just gives me the fire and the impetus to keep churning more of these videos out. I would love to get to the point where I'm doing 2 of these, maybe even 3 of these a week, and keep the episodes a bit shorter. But if that's something that you would want to see, if that's something that you think you'd enjoy, please give this video a like and let me know, and that would be awesome. Thank you so much for tuning in, guys, and I'll see you next week. Cheers.